Good evening, students. Welcome to this session. I hope you have revised your last lecture very perfectly on capital gains. Have you not? In case you have any questions, you can ask me in this particular lecture as well. But today what we are going to start with is, we are going to start with the capital gain topic. Are we clear? So we are going to start with the capital gain topic. In case you have any questions pertaining to the last class, you can ask me. Surely. Otherwise, we can just start with the capital gain topic as well. I'll wait just for 2 minutes in case you want to ask anything pertaining to the last class. Else, I can quickly start with this. Any questions you want to ask? Or should I proceed on the assumption that you do not have any doubt in capital gains? Yes? Jacob, whatever the amendments were there in the capital gain, we have covered everything. Other than that, there was one small amendment pertaining to this IFSC unit, which I did not cover it because that's very self-explanatory in itself. So only that one I have not covered. Other than that, I have covered everything with you, whatever the amendments were there. So that was just one small amendment with, and that too will get covered in the class of international taxation because that was with regard to transfer of securities by a non-resident on recognized stock exchange in IFSC, which we just did not cover. Other than that, we have covered all the amendments which were there in. So one, we had it in this thing, ULIP wala thing. So that we have covered. We have also covered the slump sale. So that we have covered. So yes, most of the amendments we have covered it. I've not left anything in that. Any other question do you want to ask? Yes. Yes, please. Yes, slump sale also, whatever was there, we have covered. Yeah, okay. Any other thing? Yes, if the individual assets and liabilities are transferred, that would not be regarded as slump sale. Cryptocurrency, Jacob, we are going to cover in the assessment of various entities class. That we are going to cover there. All right, Jacob? Okay. Yes. Okay. So let's quickly start with the section on income from other sources. Okay. So till now we have done all the other heads. We have done PGBP. We have done capital gain. The important heads, of course. Now what we are going to start with, the income from other sources, which is in fact a residuary head of income. Are we clear? So let's get quickly started. Income from other sources. Okay. Now, under the head income from other sources, so this is the residuary head of income. What is not going to be covered under the specific head of income will be chargeable under the head income from other sources. Although there are specific incomes which are covered under income from other sources as well. Amit Kumar, any dividend distribution amendments and all of that will be covered in income from other sources class. Okay, so this is the class where we are going to talk about any amendments which are going to be here covered, although there are no amendments in this particular regard. Okay. Now, like we had the general charge and specific charge under section 45, under section 28, right? Here also we have the general charge, which is 56.1. And then there are certain incomes specifically covered under 56.2. Okay. So 56.1 says income of every kind which is not to be excluded from total income shall be chargeable to income tax under income from other sources if it is not chargeable to income tax under any of the heads specified in section 14, which are the other heads of income. Okay, so if you can see here, I will just put it on screen. Okay, so this is your 56.1. So 56.1 says what? Income of every kind which is not to be excluded, meaning which is not exempt from the total income, shall be chargeable to income tax under the head income from other sources if it is not chargeable to income tax under any of the other heads. So this is my 56.1. Under 56.2, which is my specific charge, the first one which I have is dividends. So dividends are specifically chargeable under the head income from other sources, even if it relates to the business. Even if my business would be to earn dividends, but still it would be chargeable under the head income from other sources. Okay. Then income from the dividend which is there, that we are going to elaborately talk about in a greater detail. Okay. So dividend is defined under section 10. Okay, dividend is defined under section 222. So under section 222, what dividend is or how dividend is defined, that's what we are going to discuss in a greater detail. So there is the normal dividend, there is the deemed dividend. So how the dividend is defined, we can just here include, and then we are going to separately discuss the deemed dividend. So maybe you can just write it down here. Refer 222. Okay. So that we are going to separately cover in detail in some time. But just now what we are going to discuss is on 56. Screen is not visible. Okay. Now is it? I think it was not shared properly. Is it visible now? Yes or no? Is it visible now? Yes or no? Are you able to see the screen? Yes. Okay. Perfect, Jacob. So dividend we are going to cover later. Okay. Now next is what is covered under section 56. What is covered under section 56 separately? Casual income. Casual income. So casual income means the income from the winning of the lotteries, crossword puzzles, races, including horse races, card games, any other games of any sort, betting, gambling, right? Such winnings are specifically covered under 56 to 1B. So such winnings are specifically covered under section 56 to 1B, and that is chargeable therefore under the head income from other sources, right? So winning from lottery, winning from any crossword puzzle. Now these income are taxable at the specific rate of 30%. You can write it down here. Taxed at the rate of 30%. And that too on gross basis, meaning no expenditure is allowed against these particular income. So casual incomes are taxed at 30% under section 115BB. Under section 115BB, and TDS is deductible also at 30%. In excess of rupees 10,000. In excess of rupees 10,000, the TDS is also deductible. Are we clear? So these are chargeable on the gross basis. So under 194BB, winning from race horses is covered for the TDS. Winnings from race horses is covered, where the TDS is at the rates in force and not at 30%. Where the TDS is in the rates in force, with the rates in force is again 30%, right? Then winning from lottery or crossword puzzle is covered under 194B. 194B is for lottery and crossword puzzle. Okay, are we clear? So 194 B and 194BB. Both of these sections deal with the, one is with respect to the winnings from the lottery and the other is with respect to the race horses. Are we clear? Any doubt? Okay. So this is for the winnings from race horses and the lottery winning or whatever is the casual income, which is specifically covered over here. Are we clear? Now, there is one important judgment which I would like to cover herein only, which is in respect of prize money received by the distributor of the lottery tickets on the unsold lottery tickets. So there are certain unsold lottery tickets, right, which were lying with the dealer of the lottery ticket or the distributor of the lottery ticket, whether that prize money will be taxable as the business income or will it be taxable as the income from other sources? That was the question before the court. So in this case, it has been held that since this is specifically covered, so winning of prize money on unsold lottery tickets held by the distributor is not to be assessed as business income, but it is to be assessed in this particular head only. And it is to be taxed under 115BB only. So the receipt of the prize money is not in his capacity as a distributor, but as the holder of lottery ticket. He's not receiving the money because he's a distributor. So this prize money which is paid to him is received by him because he was holding that ticket, whether that was unsold or whether it was held as stock in trade or whatever. Right? So therefore, on this particular winning from lotteries are accessible under the special provisions of 115BB. The court did not conclude on whether it is taxable as income from other source or whether it is taxable as business income. But what did it conclude is that it will be taxable under 115BB, no matter if this is taxable under business head or whatever under the income from other sources. That doesn't matter. But if there's a specific rate which is given, so even if he is the distributor for the lottery ticket, still it will be considered as the a specific rate at which it is chargeable. Are we clear? Any doubt? Clear? So winnings from lottery, crossword puzzles, race horses, card games, these are specifically covered under income from other sources. You can maybe just write it over here. Winnings on unsold lottery tickets, taxable at 30%. The decision name, you can write it. This is in your module also, Manju and Company, Kerala High Court. Are we clear? Okay. Then what is specifically covered here is, what else is covered over here specifically? Now, 56 to 1B we have seen. Okay, 56 to 1B you have seen. Then we have 56 to 2. Oh, sorry, 1C. So 56 to 1, 56 to 1B, 1A is omitted. Then 56 to C, 1C. Now that is which is relating to the any sum received by the assessee from his employees as contribution to any provident fund under the provisions of the provident fund or ESIC. So you would say, ma'am, this is specifically covered under PGBP, isn't it? So we had done an adjustment under the PGBP that any sum the employee's contribution which is received by the employer is considered as the income which we included under 224(10) and we allow the deduction if it is paid before the due date, isn't it? Right? So here also we have it under the IFOS as well. So maybe what you can do is, 1 second. Here, let's make a chart so that you have the possibility of ease of studying during your exams. Okay. So what you can do is specific charge. You can write it down. Incomes specifically covered in income from other sources. Next, you can write it down. Income classified under E-force or income chargeable under E-force if not covered under other heads. Okay, and one of the example for that is employees contribution to PF. So employees contribution to PF or ESIC if not taxed under the head PGBP. If not taxed under the head PGBP. So employee contribution to PF is taxed under section 56 if it is not in relation to the expense which is claimed under the head PGBP, right? So it is quite possible that I may have the employee's contribution which is collected, but it is not in relation to the business which I am carrying on. I may be having the employees, let's say, but my income would have been more in the nature of dividend or whatever, but I would have employees, but I'm not carrying out the business activity as such. Right? I'm not carrying out the business activity as such. I have hired the employees, but I have the income which is not taxable under the head PGBP at all. I am not carrying out any business. So therefore, in that particular situation, if it is covered under income from other sources, so therefore, the employee's contribution will first be considered under PGBP, under income from other sources. And if it is paid within the due date of the fund, then the expense is allowable as deduction under 57. Okay, so same way we had it under PGBP, that first we were considering it as income of the employer under the head PGBP, and then what you were doing is you were giving the deduction under section 36, right? You were doing that. So here also similarly, less deduction under section 57 if paid before the due date of fund. Are we clear? If paid before the due date of the fund. Any questions? Okay, so that is one. Then income by way of interest on securities. If the income is not chargeable to tax under the head PGBP. So interest on securities, again, interest on securities again is covered here if not chargeable under PGBP. So if I have the trading in shares, if I have the trading in securities, if the securities are held as stock in trade or they are held for the business expediency, then the interest on securities will be taxed under the head PGBP. Else it is taxed, if it is held as investment, it will be taxed under the head income from other sources. Are we clear? Right? Next is the income from letting out of machinery, plant or furniture. If the income is not chargeable under the head PGBP. So income from letting out of plant and machinery, furniture, building, sorry, not building, plant and machinery and furniture, building is under income from house property. Yes, so machinery, plant or furniture, if these are let out, if it is not chargeable specifically under the head PGBP, then it will be covered here. Sorry. If not chargeable under PGBP. Right, so that will be covered over here. If the letting out of plant and machinery, furniture is due to the business expediency. Remember, we had done one case that time when we were dealing with the PGBP chapter. That time, if you remember, we had done one case that the let out of the plant and machinery was done in order to earn the profits out of it so that the losses are minimized, because it was during the strike period that the plant and machinery was let out. So there was the workers' strike, the factory was shut down, and because of which the plant and machinery were lying idle. Right? So therefore, it was let out in order to reduce down the losses of the business. So it was out of the business expediency that the plant and machinery was let out. Right? So therefore, in that case, it was observed that this was not income from other sources, but this was the business income, because this was let out in order to reduce the losses of the business, and it was not let out to earn the money from the letting out, right? So therefore, it was considered to be in the nature of PGBP. So if there is a lockout in the factory and if the management decides to let out the plant and machinery to another entity because of the pending negotiations with the workers, because of the strike of the worker, and it is receiving the higher charges from such let out. So then, therefore, in that particular case, it will be considered as the business income and not in the nature of the income from other sources. So unless it is taxable under the head income from business, it is not taxable under the head income from business, it will be not covered under income from other sources. Right? So these are some of the incomes which are specifically, if not chargeable under the other head, then only they will be covered here in the head of income from other sources. Are we clear? Any doubt? Any question? Any doubt? Okay. Yes. So if at all the income is in the nature of the business expediency, then in that particular case, it will be considered as the business income. Other than that, it will be considered as the income from other sources if it is not specifically chargeable under that particular business head. Clear? Any other question? Okay. Then the next one is income from the letting out of machinery, plant, or furniture which is belonging to the assessee, as well as the buildings, because the letting out of the building is inseparable from the letting out of the machinery, plant, or furniture. And if the income is not chargeable under the head PGBP, then that also will be covered over here. So income from letting out of not only plant and machinery or furniture, but building, if it is inseparable from plant and machinery and furniture. So that will also be covered over here if it is not covered under the head PGBP. So income from letting out of plant and machinery, furniture, you can write it down here. Or with building, if building is inseparable, if not specifically, or sorry, if not chargeable under PGBP. Are you clear? If not chargeable under PGBP. Then, are we clear? Okay. Then any sum which is received under the Keyman insurance policy. Any sum which is received under the Keyman insurance policy, that will be covered under income from other sources if it is not covered under any other head specifically. So any sum received under a Keyman insurance policy by the employer, that is specifically covered under PGBP under 28(6), if you remember. If it is received by the employee, then it is covered under the head salaries under section 17(3). And if it is received, let's say, by the family of the employee, then it will be covered under income from other sources under 56(2). Are we clear? So, any sum received under Keyman insurance policy. You can write it over here. Employees salary under section 17(3). Employer, then it is under the head PGPP under section 28. 6. Okay. And if it is by, let's say, the family of employee, then income from other sources under section 5624. Clear? Yes. Income from letting out of the plant and machinery also you can here write it down maybe. Temporary let out to reduce business loss, income from, sorry, PGBP. Then it is PGBP. And if the assessee is in the leasing of plant and machinery, then also it is PGBP. Leasing business, then also it is PGBP. But let's say if plant and machinery is let out after permanent discontinuance of the business or closure of business, then in that case it will be income from other sources because there is no more business in existence. Clear? Okay. Yes, so in that particular case, see here this covers winning from lottery, crossword puzzles, races, including horse races, card games, and games of any sort, or from gambling or betting, right? So any winnings from game is also covered, be it in the form of the chess player also. Are we clear, Vinay? Okay. Okay. No other questions? Okay. So Keyman insurance policy also, as I said, any sum which is received, if it is not taxable under the head PGBP or salaries, then it will be covered under income from other sources. Then next is 228, sorry, 56 to 7 and in the form of 7A and 7B. Okay. Now this we are going to cover later. First, we are going to cover all the other small 56 which are there. But the other ones, we will cover it later. So 56 to 7B, we will be covering later. The rest of the ones are omitted, which are between 56 to 4 and 56 to 7. Then we have 56 to 8, which is income by way of interest received on compensation or on the enhanced compensation. So that is specifically covered under income from other sources. So that is covered specifically here. So income from compensation, income from, sorry, interest on, income from interest on compensation or enhanced compensation. So if you remember in the last class itself, we have done under 45.5 when there is compulsory acquisition. And if there is interest received on compensation or enhanced compensation, that is specifically taxable under 56 to 8. And it is taxable on the receipt basis. So if you see section 145B, you can write it down over here. Section 145B. It provides that the interest received by the assessee on the compensation or enhanced compensation shall be deemed to be the income of previous year in which it is received, taxed on receipt basis. So if you remember, I told you that time also it is taxed always on the receipt basis under income from other sources. Are we clear? Any doubt? Okay. So other than that, there is also a deduction of flat 50% allowed under section 57(4). So you can write it down here. Deduction of flat 50% under section 57(4). Clear? Right? Next is 56(2)(9), which is any sum of money received as advance which is forfeited. Advance received forfeited, earlier we used to reduce it from the cost of acquisition before 2014, and now it is considered as income from other sources. So advance money forfeited, we had done that day also, is considered as income from other sources. Advance money forfeited is considered as income from other sources. 56(2)(10), again we are specifically going to cover it. 56(2)(10), we are going to specifically deal with it in detail. Then any compensation or payment which is received in termination of the employment or modification of the terms and condition, again that is if it is not specifically taxable under your income from salaries, then it will be covered over here. So any compensation if it is received by the family members for the termination of the employment of the employee, then that will also be covered under income from other sources. Are we clear? So you can write it down here. Any compensation for termination of employment or modification of terms. Are we clear? So that will be taxable here in the head income from other sources. Any doubt? Any question? Any doubt? Okay. Any questions? Okay. So these are the specific ones we have covered here under income from other sources. Right? Now we will focus on two more important things. Okay, here you can just write down maybe if it is not covered under salaries. Yes, here it is not covered, as I said only, but maybe you can write down. Because if it is for the employee, it will be taxable under the head salaries under section 17(3). So employee salaries under section 17(3). This is for family of employee. Then 56(2)(11). Okay. So this we have specifically here covered. Okay. Now, also here note that now we are going to focus on two most important things. One is the deemed dividend, and the second is the 5627B and 56.210. Are we clear? So that will be covered over here. Now, other than that, just few things I would like to say before we start with the deemed dividend. Income from salary received by MPs or MLAs. Whether that will be salary or whether there will be income from other sources. What do you think? The question is to you. Which insurance received, Jacob? No, that is not exempt. Salaries of MPs are not exempt. So salary of MPs, MLAs are covered under the income from other sources and not under the salaries, because the MPs and MLAs are not employed. There is no employer-employee relationship. Right? There is no employer-employee relationship. For taxability in the salary, the precondition is that there should be an employer-employee relationship, which is not there in this case, right? In the case of the salaries of MPs, because they are not employee of the parliament, right? So therefore, in that situation, it will be covered under income from other sources. Are we clear? Okay. Okay. Now we will begin with the deemed dividend. Let's start with it. Or let me start with the dividend. Now, the dividend which is there, right? We have the deemed dividend from section 222A to 222D. And dividend includes the interim dividend also. Dividend includes the interim dividend also. Okay. Now we have the specific dividends which are chargeable, even though they may not be in the nature of the dividend, but they are considered to be the deemed dividend. They are considered to be the deemed dividend. Okay. What is the basis of charge? What is the basis of charge? So section 8 which is there. Section 8 which is there is providing the basis of charge for the dividend. And what does it provide? It says that the dividend declared by the company at its AGM is deemed to be the income of the shareholder in the previous year in which the dividend is declared. So section 8 of the Income Tax Act, I'll just put it over here. You can just write it here. See, for the purposes of the inclusion in the total income, section 8, any dividend declared by a company or distributed or paid by it within the meaning of 222A, B, C, D, E shall be deemed to be the income of the previous year in which it is so declared, distributed or paid. Right? Any interim dividend shall be deemed to be the income of the previous year in which the amount of such dividend is unconditionally made available by the company to the member who is entitled to it. So the dividend is considered to be income of the previous year in which it is declared, distributed or paid. Are we clear? So section 8 is for the dividend income, the chargeability for that, for the previous year in which it should be taxable. Clear? So that is section 8. Now, let's talk about section 222A to 222E onwards. So 222A to 222E, that is now very, very important for you. Okay, deemed dividend. under section 222. First is the A1. Now, what does section 222A says? A is in respect of distribution of the company's assets. So, distribution of the assets to the shareholder. Distribution of the assets to the shareholders. Now, distribution of the assets to the shareholders, what does it provide? That any distribution of the assets to the shareholders to the extent of the accumulated profit, to the extent of the accumulated profits, whether capitalized or not, is considered as the deemed dividend. Meaning, instead of releasing the cash, if you are paying off through the assets, then you're trying to camouflage the dividend by way of distributing it in kind. So in that particular case, it will be considered as the deemed dividend in the hands of the shareholder. Are we clear? So to the extent of the accumulated profit, whether capitalized or not. Whether capitalized or not. Okay. 222B, which is there, is in relation to distribution by way of debentures, debenture stock, deposits, and bonus shares to the preference shareholder. So any distribution by the company to its shareholder of debenture, debenture stock, or deposit certificate to the equity shareholders or to the preference shares, and bonus shares to the preference, bonus not to the equity, bonus to the preference, to the extent of the accumulated profits, is considered as the deemed dividend. Is considered as the deemed dividend. So, distribution of debentures, debenture stock, deposit certificate, and bonus to preference shareholders. This is considered as deemed dividend to the extent of accumulated profits or not. Now, in case of distribution of assets to the shareholders, the market value of the assets is considered as deemed dividend. In this case, the market value of debentures or bonus shares or deposit certificate is considered as the deemed dividend. Clear? 222C, we have already seen when we were seeing the liquidation under 46.2. Remember, liquidation under 46.2 or 46.1, not taxable in the hands of the company. 46.2, it is taxable in the hands of the shareholder. But what is taxable in the hands of the shareholder is the asset value which it has received minus what is taxed under 222C. Right? So what is 222C? 222C is distribution made to the shareholders of a company on the liquidation. Right? So distribution of assets on liquidation. So to the extent of the accumulated profits, it is taxed under 222C. And Over and above that, it is taxable under the head capital gain. Clear? Are we clear? So any distribution made to the shareholders on the liquidation to the extent where the distribution is up to the accumulated profits is deemed to be the dividend income. Okay. Any distribution made out of the profits of the company after the date of liquidation is towards the repayment of the capital and cannot amount to dividend. So any distribution made out of the profits after the liquidation is not considered as deemed dividend, but is considered towards the repayment of the capital. So you can write it down here. Any distribution after liquidation is towards the repayment of capital. Right? 222D. 222D. So 222D is reduction on the capital. So any distribution to the shareholders on the reduction of the capital, then to the extent of the accumulated profits, it is considered as deemed dividend. So distribution on reduction of the capital. Clear? Last is 222E, which is more important. Now, what is 222E? 222E is advance or loan by a closely held company to the shareholder. Advance or loan held company to the shareholder. So, any payment by a company. What is a closely held company? A company in which public is not substantially interested, right? Which is a closely held company and which is not a listed company or a subsidiary of a listed company, right? So, if it is unlisted company or if it's a private company, this is always a closely held company, unless a unlisted company subsidiary of listed one. So in which the public are not substantially interested if it gives any advance or loan to any shareholder. Now, which shareholder that we are going to see. So loan or advance to a shareholder who is a beneficial owner. Shareholder who is a beneficial owner of 10% or more of the voting power of the company. So a shareholder holding not less than 10% voting power of the company as on the date when the loans or advances are made. Right? Then in that particular case, that advance or loan which is given to such a shareholder will be deemed to be the dividend to the extent of the accumulated profits. To the extent of the accumulated profits. Are we clear? So here if you see, here the wordings used are to the extent of the accumulated profits. Here it is not said whether capitalized or not. So in all the other cases, it was clearly mentioned that whether or not the accumulated profits are capitalized. So here the accumulated profits will exclude the capitalized profits. So you can write it here. To the extent of accumulated profits excluding the capitalized. Because in 228A to D, it is clearly mentioned accumulated profits whether capitalized or not. Here, nothing like that is mentioned. Alright, so if any loan or advance is given to a shareholder who holds beneficially more than 10% of the voting power of the company, that will be deemed dividend. Or any payment by a company in which is a closely held company to any concern. So any loan or advance to a concern HUF firm, AOP, BOI company, whatever, in which shareholder having the beneficial ownership of at least 10% of the equity shares. So the shareholder which is holding more than 10% of the equity share is a member or partner in that particular firm and has the substantial interest, that is 20% of the income of the concern, then in that particular case, it will be considered as the deemed dividend. So, what is it said? If you are giving any loan or advance to a shareholder who holds more than 10% of the voting power, or if you are giving any loan or advance to any concern in which such a shareholder is a member or a partner and has the substantial interest. What is the substantial interest? The substantial interest means that the person, the shareholder, is entitled to more than 20% of the income of that particular concern. So, you can write it down. Advance or loan to concern in which shareholder holding greater than 10% or greater than equal to 10% of voting power holding greater than equal to 10% of the voting power is a member or partner and is entitled to greater than equal to 20% of income of that concern. Income of that concern. So he has the substantial interest at any time, right? Then in that particular case, this will be considered as the deemed dividend. Right? This will be considered as the deemed dividend. So this you can write it here. And is entitled to greater than equal to 20% of income of concern, meaning it has the substantial interest in the concern. So substantial interest means greater than equal to 20% of the income. Clear? So to the extent of the accumulated profits, this will be considered as the deemed dividend. Clear? Then third, any payment by a company which is for the individual benefit of such a shareholder. is also considered as deemed dividend. So any payment on behalf of or for the benefit of such a shareholder is also considered as deemed dividend. Or any payment or benefit of or on behalf of such shareholder to the extent of accumulated profit is considered as deemed dividend. Are we clear? Any doubt? Okay. Now, what does dividend does not include, or what will not be considered as the deemed dividend? Okay. But before that, what is the meaning of the term accumulated profits? What is the meaning of the term accumulated profit? Now, as I said, the accumulated profits which are there for the purpose of distribution of assets under A, for the purpose of the distribution of the debentures or bonus shares to the preference shareholders under B, for the purpose of the accumulated profits for the purpose of 222D, which is reduction of capital, or 222E for the advance or loan. In all these cases, the accumulated profits includes all the profits of the company up to the date of distribution or payment of dividend. You can write it down here. Accumulated profits up to the date of distribution or payment of dividend. These dividends are not declared, right? Even in case of 222E. However, in case of dividend under section 222C, which is in the case of the liquidation, the accumulated profits to be considered up to the date of the liquidation of the company. Up to the date of liquidation. Right? Up to the date of the liquidation. Now, also if you see now for the accumulated profits, building and machinery depreciation fund not to be included in accumulated profits. So, building and depreciation fund not to be included in accumulated profits. Right? Building and depreciation fund is not to be included in the accumulated profits. Clear? Any doubt? In case of the amalgamation, so in case of specifically amalgamated company, the accumulated profits of the amalgamating company on the date of amalgamation shall be included in the accumulated profits of the amalgamated company. Are we clear? So, accumulated profits of amalgamated company to include accumulated profits of amalgamating company on the date of amalgamation. Clear? Are we clear? Now, what does the dividend does not include? Or what are the exceptions to the deemed dividend, especially in the context of 222E? Okay. So the exception to these 222E are loan granted in the ordinary course of business. If the loan is granted in the ordinary course of business, and if the lending of money is the activity of the business, is substantial part of the business, then the loan or advance to a shareholder is not deemed to be dividend. So, loan granted in the ordinary course of business. Okay, if the loan is granted in the ordinary course of business, then it is not considered as the deemed dividend. Trade advances are not to be treated as deemed dividend. Trade advances. So, if you see that, CBDT has also given a clarification regarding this, that what are the trade advances. So where advances are made by a company to a sister company, to a related company, and let's say these advances are given for the job work to be done or any kind of assignment to be done by the other company, then these are in the nature of the business transactions and do not fall under deemed dividend. Or where the advances are made by the company to the shareholder, let's say to install the plant and machinery at the shareholder premises to enable him to do the work for the company so that the company can fulfill the export order. These are in the nature of the business expediency and not in the nature of the deemed dividend. Or let's say a security deposit is given by the company to its related company against the use of any asset belonging to the related company, right? The company then will utilize that particular asset to generate the, let's say, electricity and supply it to the sister concern at the concessional rate. So these kind of security deposit which are made by the company to the sister concern is again a business transaction, is in the normal course of the business between the two companies, and therefore it will not attract 222E. So trade advances will not result in deemed dividend. There are plethora of cases in this regard, and many are given in your module 2. So let's say if there are any financial transactions which have been entered into. So in that particular case, whether 222E would be attracted. So where, let's say, for example, the assessee was involved in booking of resorts for the customers, right? So where the assessee was involved in booking of the resorts for the customers, and it, as a part of the day-to-day business activities, had entered into the financial transactions with those customers, right? So whether in that case, can we say that here the deemed dividend will be attracted if any loan or advances are given in the course of the business of the assessee, in the course of the business of the assessee. So in that case, the Delhi High Court, in the case of ambassador travel, had held that these particular transactions are in the nature of the business activity. So here, what the assessee was doing is that the assessee was engaged in the business of travel agency. It had entered into the business transactions with its own with its two related companies. And these financial transactions, the assessing officer had put that in the category of deemed dividend. So The travel agency, as a part of the travel agency, assessee had a regular business dealings with the two sister concerns which it had, which were also engaged in holiday resorts and tourism industry. And if it gave any advances or loans in that particular carrying out of that particular business activity, therefore, in that case, it will not be considered as the deemed dividend. So these were the part of the day-to-day business activities of the assessee, and therefore that would not be considered as the deemed dividend. Are we clear? Similarly, there have been other cases, let's say for example, where the loan or advance is given to a shareholder in return for an advantage conferred by the shareholder to the company. So if, let's say, there is a shareholder who is giving some kind of benefit to the assessee or to the company, so whether that would be considered as the deemed dividend. So it was in the context of this particular case that the High Court held that by way of loan or advance which is appearing under 222E, that must be construed to mean those advances or loan which a shareholder enjoys being a beneficial owner of the shareholder, being the beneficial owner of the shares, where he is holding not less than 10% of voting power. But if such loan or advance is given to the shareholder in consequence of any other consideration which is beneficial to the company, and where the company is receiving some kind of benefit from the shareholder, such a loan or advance cannot be held to be deemed dividend. So where the advance was given by the company to the shareholder as a compensation for keeping his property as a mortgage on behalf of the company so that the company could obtain the loan, then that was not deemed dividend under 222E. So in this case, the assessee had mortgaged his property to the bank so that the company can obtain the loan on mortgage of the shareholder's property. And the company had paid some compensation to the shareholder because it was unable to repay the mortgage or release the property from the mortgage. So in such a situation, if the decision was taken to give advance to the assessee, that was not a deemed dividend, but that was a compensation. That was not in, the shareholder was not receiving in the right of a shareholder, but he was receiving as a compensation for what he had done for the company. Are we clear? Any doubt? Then the next case is in respect of whether the repair and renovation expenses in respect of the premises leased out by the shareholder. So if the company is using the property of the shareholder, the company has taken the property of the shareholder on the lease. The company has taken on lease the property of the shareholder. It has taken the lease from the shareholder only. The property was of the shareholder. Now, if the company is carrying out some repair and renovation expenses, then can it be said that it's a deemed dividend? So again, the court, Bombay High Court had held that repair and renovation expenses in respect of premises owned by the shareholder are not to be treated as deemed dividend because the expenditure which is there on repairs and renovation is done for the property and it is not in the nature of loan or advance. It cannot be treated as a payment for advance or any loan, and that would not be considered as the deemed dividend. In another very important decision, the question was that what are the tests for determining the substantial part of business of lending company for the purpose of application of 222 exclusion. So if the company is giving the advances and it is in the ordinary course of business, right? Or where the lending of money is a substantial part of the business of the company, then, or you can write it over here. 1 second. Lending is part of substantial business of company. Then what is substantial business? So percentage of turnover needs to be seen, that is percentage of the lending business in relation to the entire business of the company needs to be seen. Percentage of employees who are in the lending business in relation to the total workforce which is there needs to be seen. What is the capital employed for the lending division in comparison to the total capital employed needs to be seen in determining whether the company is substantially engaged in the business of lending or not. Are we clear? Right? Any doubt? Okay. Next is, there is also the exclusion in terms of dividend paid is set off against the deemed dividend. Okay. So where a loan had been treated as a dividend and now subsequently the company declares and distributes the dividend actually, including to the borrowing shareholder, then the dividend so paid is set off against the previous borrowing. The adjusted amount will not be again treated as a dividend. So where a loan had been treated as a dividend and subsequently the company actually declares and distributes the dividend to all the shareholders, including the shareholder who has borrowed the fund, then the dividend so paid is set off by the company against the previous borrowing. Dividend which is paid is set off against the previous borrowing. Then the adjusted amount will not be again treated as dividend. Clear? That's just a clarification which is given, right? Also, one more important point is that subsequent repayment of loan, if the loan is repaid subsequently, whether that would result in that the amount of dividend will reduce. Let's say I've taken the loan and I've made the repayment entirely. So there is no outstanding loan at the year end. So whether 222E will not be attracted, the answer to that is no. Subsequent repayment of loan will not make any difference in applicability of 222E. So you can write it down. Subsequent repayment of loan doesn't impact 222E. Okay. Now, what does not constitute dividend? What does not constitute dividend? Payment on buyback of shares. So buyback of shares is not a dividend. Buyback of shares is not dividend. Clear? Distribution of shares to the shareholders on demerger by the resulting company. Distribution of shares to the shareholders by resulting company during demerger is again not considered as dividend. Clear? Are we clear? Any doubt? Any questions? Any doubt? Any questions? Are we clear? Clear? Yes or no? Okay, so we have covered the deemed dividend, dividend. Now we will move on to 56 to 10. But before that, I would suggest let's take a small break of 10 minutes and then we get back and then we start with 56 to 10. Because otherwise we'll not be able to take break for then another 30 minutes. Let's take a break of 10 minutes. Okay. Okay, students. So I hope that the dividend taxability and dividend taxability is clear to you. Okay. Now we are moving towards the 56 to 10, which is very important again, which is also known as the kind of gift taxation, right? Now, what is this? Let's try and understand. So, where if you receive any three of this, okay, uh, 1 second. I think there's some problem. Give me a minute. Okay, yes. So, in case of the gift, if you receive of any these three particular sum, right? Or three assets, not some, but three assets, then it will be considered that this is your income under section 56 to 10. Okay. So what is that exactly? Let's try and understand. So receipt of or receipt by, okay, receipt by any person, receipt by any person of cash greater than rupees 50,000. So this entire amount is taxable under section 56 to 10. Clear? Second is immovable property. Received without consideration, received without consideration, where stamp duty value of the property exceeds rupees 50,000. Stamp duty value of the property exceeds rupees 50,000, then entire stamp duty value needs to be taken into consideration. So if it is without consideration, without making any payment, if you receive immovable property as gift, then it is considered as the income. For inadequate consideration, where you're paying the consideration, but that is not adequate. How do you measure whether it is adequate or not? So where SDV minus consideration paid is greater than higher of rupees 50,000 or 10% of the consideration. 10% of the consideration. Then in that particular case, this will be considered as the income under the head IFOS. If the consideration is paid and the difference between the stamp duty value and the consideration is more than the higher of 50,000 or 10% of consideration, the difference between the stamp duty value and consideration shall be chargeable in the hands of the assessee as income from other sources. Are we clear? Now, again here, if you remember, we have done this under 50C as well as 43CA. If the value as on the date of agreement is different from the date of the registration. So in that case, the stamp duty value may be taken on the date of agreement if the amount is received, if whole or part of the amount is received by way of the account pay check or any other ECS or electronic mode, then the date of agreement may be taken. Else you can take the date of the registration. Clear? So you can write it over here. If SDB on date of agreement different from date of registration, if whole or part of the consideration is received through account pay check or electronic means on or before date of agreement, then you can take yes, agreement date, and no, registration date. Clear? Are we clear? Now, if it is, this is SGB, okay, here you can write SGB. Now, if in the case of the immovable property, in the case of immovable property, from the perspective of the seller, if it is held as capital asset, then section 50C will apply, right? Section 50C will be applicable, and you will take the stamp duty valuation. But when will you take the stamp duty valuation? The stamp duty valuation will be taken if the SDV is greater than 110% of the full value of consideration. Right? 110% of the full value of consideration. And again, what you need to take is, if the date of agreement is different from the date, if the SDV on the date of agreement is different from the date of registration, then in that particular case, what you need to do is, you need to consider, here you can write it down, if date of agreement is, one second, is different from the date of the registration and not the SDV. Okay. So in that particular case, which SDV you will take is, you will take the SDV on the date of the agreement if the whole or part of the consideration is received by the account pay check or electronic mode. Otherwise, you will take the SDV on the date of registration. Right? If the seller has held the immovable property as stock in trade, then section 43 CA will be applicable. Then section 43 CA will be applicable, right? Again, you will take the SDV, but the other principles will remain the same, right? It should be the SDV greater than 110% of full value of consideration, and on which date you have to take, that also will remain the same. From the buyer perspective, if it is received without consideration, and if your SDV is greater than rupees 50,000, then SDV is taxable. If it is inadequate consideration, then we have already seen if the difference between the SGV and the consideration is greater than higher of 50,000 or 10% of the consideration, then in that particular case, you need to consider the differential amount which is taxed as income from other sources. Are we clear? So it will be taxed in the hands of both the buyer as well as in the hands of the seller. This is under 56(2)(10). Where the stamp duty value exceeds the consideration, then higher of the amount of 50,000 and the 10% of the consideration. Are we clear? That needs to be taken up. Okay, this should be and not or. One second. This is and. Okay, here also you can just make a correction. It's and. Okay, this is for the immovable property. Now for the movable property, so for the movable property, or you can write it down, movable property, then if it is received without consideration, then the fair market value of the property, if it is greater than rupees 50,000, then the fair market value is taxed as income from other sources. If it is received for inadequate consideration, and if the FMV minus consideration is greater than rupees 50,000, then FMV minus consideration is taxed. Here also you can write down SGV minus consideration is taxed. Clear? Okay. Okay. Are we clear? Any doubt? Any questions? Okay. Any question, any doubt? Okay. Now, any other movable property? Property means what? Capital asset, which includes shares and securities, jewelry, archaeological collection, drawings, paintings, sculptures, any work of art, right? So here you can write it down. Property means capital asset, right? And movable property here will include and not stock in trade. So your stock in trade is not included. Movable property will include shares and securities, work of art, drawings, paintings, right? Any sculptures, all of that, right? Jewelry, archaeological collections, all of that is included. Clear? Now 56(2)(10), would not be applicable in certain situations. 56 to 10 is not applicable in certain situation. And what is that? Let's try and understand. So this will not be applicable. I'm just putting out a list. Okay. And write down here 56 to 10 not applicable. Okay, so these are the situations which are covered. If it is received from any relative. Now, what is the meaning of the relative? Who is the relative? So, relative means, just write it down. Relative means this. In case of an individual, it means the spouse of the individual, right? Brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, parents, grandparents, children, grandchildren, and spouse of the above. So it means spouse, then brother and sister, your siblings, right? Siblings of your spouse, then grandparents, parents, so lineal ascendants, grandchildren, children, linear descendants, and brother or sister of the parents, of either of the parents, right? And then spouses of these individuals, correct? Which are mentioned. So that is the meaning of relative. So any gift received from relative is not covered here. On the occasion of the marriage of the individual, any amount you are receiving on the marriage, if you're receiving more than 50,000, that is not taxable under 56 to 10. Under a will or by way of inheritance, in contemplation of the death of the payer or the donor, from any local authority, from any fund or foundation or university or other educational institution or hospital or other medical institution or any trust or institution which has the exemption under 1023C, from or by any trust or institution registered under 12A, 12AA or 12AB. So in these cases also, it will not be considered that the gift has been, that the 56 to 10 is being applicable. However, in these two cases, where the exemption to the institution is given under 1023C or under 12A, 12AA, 12AB, in these cases, it has been provided that this shall not apply where any sum of money or any property has been received from a person referred to under section 13.3. Now, what is 13.3? Where 13.3 is in relation to the section 11 not applicable, which you will learn in the charitable trust lecture. You will learn that in certain situations, section 11 is not applicable if in these cases, if the amounts has been received from the person who is the founder of the trust or who has made the substantial contribution to the trust or who is the author of the trust or any relative of such particular founder, in these cases, that exemption will not be considered, which is given over here. So here, what it is trying to say is that in case the amount is received from the trust, from the charitable trust or medical institution or education institution which have the exemption under 1023C or 12A, then in that case, it will not be considered as the taxable amount under 56 to 10. However, this exemption will not be applicable in a case where the sum of money or property has been received by any person which is the author of the trust or the founder of the trust or relative of any author or founder. Okay, so you can just make a note of it here. Except when received by author or founder of trust or their relative or person who has made substantial contribution. Section 13(3). Okay, so this particular exceptions will not apply where sum of money or property has been received by these particular persons. Okay, then by any fund or trust or other university or medical or educational institution which has again claimed the exemption under 1023C. Okay, then by way of transaction not regarded as transfer under section 47. Now again, if you see here what they have said is that the transactions which are not regarded as transfer under section 47, if it is in the course of receipt of any of these transactions undertaken, then in that particular case it will not be considered to be taxable under section 56 to 10. So now what are these transactions which are undertaken? So first is under 47. First is under 47(1). Now 47(1), if you see, is distribution of the capital assets on total or partial partition of HUF. You can write it down if you want over here. So I can just make you write here. You can just remove this and I can give you the, because otherwise you'll get confused. Okay. By way of transaction not regarded as transfer, under 47, which is distribution of capital asset on partition of HUF oblique. In the case of 47(4) and 47(5), what is 47(4) and 47(5)? 47(4) and 47(5) was distribution of capital asset by the holding company to wholly owned subsidiary or vice versa. So if that is the case, it will not be covered under 56 to 10, right? So distribution of capital asset by holding company to wholly owned subsidiary or vice versa. Are we clear? Then 47(6)(a), 6(a), which is in the nature of amalgamation. Amalgamation of the capital asset by the transfer of capital asset during the amalgamation by the amalgamating company to the amalgamated company, or in the case where two foreign companies are amalgamated and by result of which the shares in the Indian company are transferred, in that particular case as well. Then in the case of also demerger, if there is a demerger of the Indian company by virtue of which the capital asset is transferred, or in the case where there is a demerger of the foreign company in consequence of which the Indian company's share is being transferred, or in the case where there is the business reorganization, or in a case where there is the transfer of shares by the resulting company in a scheme of demerger to the shareholders of the demerged company, right? So if there is any transfer of shares by the resulting company, so if the resulting company issues the shares to the shareholders of the demerged company, that also again the shareholders would not be falling within the 56 to 10 applicability. Then also in the case where there is the applicability of this thing, what do we say, this transfer during the reorganizations which are there, right? Conversion which is there, all of these transfer are not covered over here. So you can just write it down. Amalgamation or demerger. Amalgamation or demerger, right? Correct? Any doubt? Any doubt? Any questions? Any doubt? Okay. So all of these transactions are not covered within the purview of the 56(2)(10). Then from an individual by a trust created or established solely for the benefit of the relative of the individual, then in that other case from such class of people as the as may be prescribed. So this we can just remove because it's not prescribed. Okay, now this is very important and this is where the amendment has been brought. Okay, now let's try and understand this particular part which is there. Okay, it says and by an individual from any person. So what does it say? By an individual from any person in respect of an expenditure actually incurred by him on his medical treatment or treatment of his family for any illness related to the COVID-19. So in respect of expenditure actually incurred by him on medical treatment or treatment of any member of his family. So any amount which is received or any money or amount or any property which is received by any person which is in relation to the illness of COVID, any expenditure incurred on that. So let's say the individual has received any amount from any person in respect of expenditure actually incurred by him on the medical treatment of himself or his family, right, for COVID related illness, then that amount will not be taxable under 56(2)(10). However, the individual has to keep the record of the COVID-19 positive report of the individual or his family member, all the necessary documents of medical diagnosis, and the amount so received in any financial year has to be furnished in form number 1 to the income tax department within 9 months from the end of the financial year. So if the assessee has received any amount, then he has to furnish the details to the income tax department. That is one. Secondly, if the member of the family of deceased person, this is for the individual, right? If the member of the family of the deceased person has received the amount from the employer of the deceased person or from any other person to the extent it does not exceed 10 lakh. Where the cause of the death of such person is illness related to the COVID-19 and the payment is received within the 12 months from the death of such person, then that amount will also be not covered under 56(2)(10). Here, the only condition is that the death of the individual should be within 6 months from the date of testing the positive. And the family member has to keep the record of COVID positive report, medical report, death certificate, and has to furnish the information in Form A to the assessing officer within 9 months from the end of financial year. Clear? Here, the family means spouse and children of individual, parents, brothers and sisters of the individual who are dependent on the individual. Clear? So you can write it down over here. Here I'll give you a chart. 56(2)(10) excludes. I'm giving you a chart for only last two amendment 1. Amount received for expenditure on medical illness due to COVID. Right? Due to COVID. If it is received for self, not covered under 56(2)(10). For the family, again, not covered under 56(2)(10). Clear? Furnish report to income tax department in form 1 within 9 months from end of the financial year. Within 9 months from the end of the financial year. Next is amount received by family on death of individual. What is a family? Family is spouse and children. Spouse and children or dependent parents or siblings. Right? Then if it is received from employer or from any other person up to rupees 10 lakh. Here there is no limit on the amount. But for the death, there is a limit not from the employer, but for the other person. This amount can be received from any person. From any person. This has to be from employer, and if it is from any other person, it is up to 10 lakh. Then this will not be covered by 56(2)(10). Right? Details to be furnished in form A within 9 months from end of the financial year. Are we clear? Any questions? Any doubts? Any questions? Any doubt? Any questions? Any doubt? Yes, the cause of the death should be COVID and the person should have died within 6 months. You can write down death of individual due to COVID within 6 months from COVID. Okay. Yes. Okay. Now, last few instances, what I would like to cover is, and then, maybe what we can do is we can take up a small question and then we are, almost done with this chapter. Okay. Now, the CBDT has also notified few transactions, which I'm just orally telling you, where 56(2)(10) is not applicable. Where the immovable property is received by a resident of unauthorized colony in national capital of Delhi, right? So where a person has received any immovable property in unauthorized colony, who is a resident of an unauthorized colony in Delhi, the condition is the central government by notification has regularized the transaction of such immovable property based on the power of attorney, agreement to sale, will, possession letter, or any other documents evidencing the payment of consideration for conferring the right of ownership on that particular resident. Right? So if the person has received any property, who is a resident of any unauthorized colony, but he has all the possession letter and all of that, then in that particular case, the 56(2)(10) will not be applicable. Now, what is unauthorized colony? Unauthorized colony means a colony or a development comprising of a contiguous area where the permission has not been obtained for approval of layout of plan or building plans. Clear? Secondly, any property which is in the nature of unquoted shares, which is in the nature of unquoted shares of a company and its subsidiary, then the shareholder who is receiving the property will not be liable for 56(2)(10) applicability, where the tribunal on the application of the central government has suspended the board of directors and the company has gone for the insolvency proceedings. Then in that case, the 56(2)(10) will not be applicable on the receipt of the unquoted shares. Clear? Then any movable property being equity shares of the reconstructed bank, where the share has been allotted under the Yes Bank Limited reconstruction scheme. Again, 56(2)(10) will not be applicable. Or any movable property being equity shares of the public sector company, which is received under strategic disinvestment. Again, that will not be considered as the for the applicability of 56(2)(10). Okay. Now, for the purposes of the FMV of the shares and security or any other movable property which is received, what is the fair market value? What is the fair market value? That is what we are going to see now. So what is the fair market value in case of the 56(2)(10) for the movable property? Now that is given under Rule 11UA. Remember, we have already done Rule 11UAA when we were dealing with 50CA. Remember that? We have done that. So what is Rule 11UA? Let's try and understand. It gives the valuation for the immovable property. For immovable property, we have SGV. For movable, we have the FMV. Now, how will FMV computed? That is given under Rule 11UA. Determination of the fair market value. Right? So for the jewelry, you can write it down. You can write down. For movable property, Rule 11UA. For jewelry, the value is, the fair market value shall be the price which such jewelry will fetch in the open market on the valuation date. Right? If it is a purchased jewelry, then you can of course take the invoice value. In case the jewelry is exceeding 50,000 rupees, then in that case, you have to obtain the valuation report from the registered valuer. So you can write down. You can write down market value, invoice value if purchased, if greater than 50,000, valuation report. Clear? Then archaeological collections, drawings, paintings, all of that again same. So I'm writing it the same way for archaeological collections, drawings, paintings. It's the same valuation. Okay. for the valuation of shares and securities. Okay. In case of the quoted shares, in case of the quoted shares and securities, it is through the recognized stock exchange. Then the fair market value of such shares will be the transaction value on the stock exchange. Transaction value on the recognized stock exchange. If the quoted shares and securities are received through the off-market transaction, quoted shares received through off-market transaction, then the lowest price of the shares on the recognized stock exchange on the valuation date is to be taken. Lowest price on the recognized stock exchange. Okay, and in case there was no trading, then on the previous day you can take it out. In case of the unquoted equity shares, unquoted equity shares. So this we have already seen, which is A plus B plus C plus D minus L into PV upon PE. This you have also seen in section 50CA. So 50CA is the book value of all the assets other than jewelry and all of that, right? As reduced by the amount of income tax paid plus the income tax refund minus the amount of deferred expenditure. B is the price of the jewelry and artistic work. C is the fair market value of shares and securities as determined in this rule. D is the stamp duty value of immovable property. L is the book value of liabilities, but not including paid up share capital provisions and contingent liability. PV is the paid up value of equity shares, and the PE is the total amount of paid up equity share capital. Are we clear? Clear? Then last is unquoted shares other than equity. Other than the equity shares and securities, which are not listed on recognized stock exchange, the fair market value will be as per the valuation report. As per the valuation report. Clear? Are we clear? Okay. Next is, so I've explained you 56 to 10, right? I've explained you 56 to 10. So how 56 to 10 valuation is also carried out, that also I have explained you by way of the rule. Any doubt with respect to this? Sorry. Any doubt? Any questions? Any doubt? Yes, in case of purchase of jewelry of more than 50,000, you have to obtain valuation report. Any other question? Okay, now one case law I would want to cover on this particular point, which is in the context of 56 to 10 only. Now, what is this case? Let's try and understand. So this case is regarding whether the bonus shares received by the shareholders will be covered under 56 to 10 as they are received without any consideration. Because bonus shares, you do not pay any consideration. So whether we can say that it is taxable under 56(2)(10). So Karnataka High Court in a case held that the issue of the bonus shares is by capitalization of reserves which are reallocated now by issuing the bonus shares. Inflow of fresh funds or increase in capital employed. It remains the same. So there is no addition or alteration to the profit-making apparatus. Total funds available with the company remain the same. Also, on the other hand, when a shareholder gets the bonus shares, the value of the original shares goes down. Market value as well as the intrinsic value of the shares will remain the same. Thus, any profit which is derived by the shareholder on account of receipt of the bonus shares is in fact adjusted by way of reduction in the equity shares which he was holding earlier, because the value of the old shares will also get declined, right? Hence, 56(2)(10) will not be attracted in the hands of the recipient shareholders on receipt of the bonus share. Are we clear? So, receipt of bonus shares will not be considered for the purpose of 56(2)(10). 56(2)(10) will not be triggered on receipt of the bonus shares. Are we clear on this point? Okay. Now, last one section which is remaining here is 56(2)(7)(b). 56(2)(7)(b). And what is this section regarding? This is closely held company receiving consideration from the resident shareholder. 56(2)(7)(b). Closely held company receiving consideration from resident shareholder. Okay, now what is this particular decision about? What is this particular 56(2)(7) provision about? Let's try and understand. So where a closely held company, a company in which public is not substantially interested, receives the consideration for the issue of shares. So let's try and understand where a closely held company receives consideration on issue of shares. Which is greater than the issue price. Which is greater than the issue price of the share. Right? So, which is greater than the issue price of the share or the face value of the shares. Let me write it instead of the issue price. You can write it. Face value of the shares. Then the consideration minus the FMV. Consideration minus FMV is taxed under 56(2)(7)(b). Is taxed under 56(2)(7)(b). So where a closely held company is receiving the consideration greater than the face value, then that will be taxable. The difference between the consideration and the FMV will be taxed under 56(2)(7). Right? Will be taxable. Now, what is the FMV over here? The FMV over here is again as per rule 11UA. Rule 11UA. But here the constitution is, sorry, the FMV is differently calculated. How is it calculated? A minus L upon PE into PV. This is A minus L upon PE into PV. Now, what is A? A is the book value of the assets. A is the book value of the assets minus the tax paid either as TDS or TCS or advance tax, right? Plus the tax refund and reducing the amount of any deferred expenditure. So minus tax paid plus tax refunded minus deferred expense. Deferred expense, right? L is the book value of liabilities. But again, excluding the paid up share capital, amount of any reserves and surplus, any contingent liabilities, all of that has to be excluded, right? All of that has to be excluded. So I'll just put it over here. You can just exclude that, right? Excluding this amount. And P, as you can see, is the total amount of paid up equity share capital, and PV is the paid up value of equity shares. So this is the fair market value of unquoted equity share. Fair market value of the unquoted equity share. Or what you can do is you can take a report from the merchant banker as per DCF method. You have learned in SFM what is discounted free cash flow method. So either of this you can use for the valuation. Okay. So either this or as per the DCF method, discounted free cash flow method. Are we clear? So this is your fair market value, how you have to compute for 5627B. Let's take one example. Let's take one example for this. But before that, again, there are exceptions to the 5627B also. What are the exceptions to the 5627B? 5627B is not applicable. Not applicable in a case where the issue of share is by the venture capital undertaking or venture capital fund or venture capital company. Issue of shares by venture capital fund or venture capital undertaking, right? By the company which is a startup registered under the startup exemption which is there, which is the startup which is registered under the startup exemption. So eligible startup. Eligible startup, which is recognized by Department of Industrial Trade and Promotion, right? And what are the additional conditions for this particular startup? Let's try and understand that. This is very, very important. This can form part of your MCQ as well. Okay, so the central government has notified that the provisions of 5627B will not apply to the issue of shares by the startup which has received the recognition of startup from the Department for Promotion of Industry and Internal Trade. So central government has but issued certain notifications for the conditions to be fulfilled by the startup company. And what are the conditions which are to be fulfilled for a startup to be eligible for exemption under 5627B? it should be recognized by DPIIT. The paid up share capital and share premium should not exceed 25 CR. Paid up share capital and share premium less than rupees 25 CR. Right? Then the consideration which is received by the startup. The consideration which is received by the startup for by such startup for shares issued shall also be exempt, and if it has issued the shares to a non-resident or venture capital undertaking, then that amount will not be considered in the paid capital. Right? So that amount will not be considered in the paid up share capital. Then it should not have invested in the following assets. It should not have invested in the following assets. Not invested in the residential house property, then your land or building other than one occupied by the startup for his business, other than for the business, then loans and advances other than if it is in lending business, then capital contribution to other entity, then shares and securities, then in any other assets which is in the nature of transportation vehicle, motor vehicle, aircraft, yacht, the cost of which exceeds 10 lakh, motor vehicles, yachts, aircraft greater than rupees 10 lakhs, and in jewelry, archaeological collection, drawings, painting, right? All of these it should not have invested in. For a period of 7 years, from the latest financial year in which shares are issued at premium. Right? Now, when is the company considered to be the startup? When is the company is considered to be startup for a period of 10 years from the date of incorporation or registration. And the turnover limit, it should not exceed 100 crores since the incorporation or registration, and it should be engaged in the business of innovation, development, or improvement of processes or with a scalable business model. Right? So that is considered as startup. And if it is a registered startup fulfilling these conditions, then the provisions of 5627B will not be applicable to the company if it fulfills these conditions. And if the company fails to comply with any of these conditions, then the consideration received for issue of the share that exceeds the fair market value of the share shall be deemed to be the income of the company in the previous year in which it fails to comply with the condition. And it will be deemed that the company has underreported the income in consequence of the misreporting. So this is going to be considered as misreporting of the income, for which penalty at the rate of 200% of the tax payable would be leviable. So failure to comply with conditions 56 to 7 be applicable, plus misreporting of income. So therefore there will be penalty at the rate of 200%. Penalty at the rate of 200% under section 270A. This is very, very important. Are we clear? Any doubt? No, Vinay, you need to require the valuation report for the DCF valuation. Any questions? Any doubt? Is this 56 to 7B clear? One small question which I'm writing it down. You need to give me the answer. Let's say the face value is 100. Two cases I'm giving you, 100, 100. Fair market value is 120. Right? Issue price is, let's say, 130 and 150. Sorry, make it let's 110. 130 and 110. What is the taxable amount in the first case and second case? Please tell me. What is the taxable amount in the first and second case? Yes, correct, Vinay. Yes, very good. No, Jacob, not the right answer. Okay. So in the first case, it will be, since your issue price is exceeding the face value, so therefore in that case, your issue price minus the FMV, the consideration minus the FMV 10 is taxable. In the second case, your issue price is exceeding FMV, so 56 to 7B is applicable. What is the consideration here? 110. What is the FMV? 120. So here nil will be taxable because issue price is less than the fair market value. Clear? So the answer is will be negative. So here it will be nil. Clear, Jacob? Are we clear? Any doubt? Okay. Now, last two cases which are there in your module, which I would just quickly cover it. One is with respect to the interest income from the share application money deposited in the bank account, right? So if you remember, we had done the case of Henkel's pick in PGBP. If you remember, do you or don't you? Henkel's pick case in PGBP, interest on the share application money, when it will be taxable. So we had seen that the Supreme Court in that case had held that the share application money until and unless the shares are allotted, the company cannot use that money, right? So the company, since it cannot use that money, the money which it is depositing in the bank, and on that it is generating some interest, that interest, it cannot be considered as the income of the assessee, because the assessee is not able to utilize the money only. When it will be able to utilize? When it will allot the shares. When it will allot the shares only, then it will be able to utilize. So till then, the interest will not be considered as the income of the assessee. So that was the Henkel's Pick decision, right? We had seen it in PGBP. Similarly, there is another Supreme Court ruling of Sri Rama Multitech, wherein it has been held that the assessee company was required to keep the share application money till the date of allotment of shares. So the money will be returned to the unsuccessful applicants, and therefore the entire share application money cannot be used by the assessee. So interest which is earned is inextricably linked with the raising of the share capital. So any surplus money which is deposited in the bank for the purpose of earning the interest is to be taxed under income from other sources. That is very clear, because it is in the nature of the interest, which is not for the business purpose, but it is more so to do with that the money is deposited in the bank till the time the share application is completed. So here the share application which was deposited with the bank was not to make the additional income, but to comply with the statute. So the interest accrued on the deposit is merely incidental. And since this interest, or since the issue of the shares relates to the capital structure of the company, the expenses which are incurred in connection with the issue of the shares are also to be capitalized, right? Unless it is for the purpose of the new company, wherein we have the 35D, where we take 1/5 of the expenditure, right? So here, if it is for the issue of the shares, then other than that, we capitalize the expense, and the interest income which is there has to be set off against that expenditure. That was what was held in this particular decision. Are we clear? So if you remember, we had done that in section 28 itself. Let me see if I can find out that decision again, where I have written. Yes, we found out. So here maybe you can make a note in Henkel's Pick. You can make a note here. You can write down the case Rama Multitech Limited. So here it was held that the interest will be taxable only after allotment is completed, but you can write interest income to be set off against public issue expenses, which are capitalized. Are you clear? Which are capitalized. Any doubt? Okay. There is one more decision which is given over here, which is in the context of the interest which is earned, prior to the interest which is earned prior to the commencement of the business. So interest income before the commencement of the business on deposit of surplus fund will be taxed under income from other sources. You can write down here that you can write down under income from other sources chapter only. One second, what has happened? Yes. You can write down. Or maybe just put it in the year only. Income from other sources. Interest on surplus funds earned prior to commencement of business from other sources. Income from other sources. Clear? So even your ICDS 9, which is there on the borrowing cost, that also provides that the income earned on temporary investments made out of the borrowed funds which are pending to be utilized on the expenditure for the qualifying asset is not to be reduced from the borrowing cost incurred. Okay. So an amount which has been incurred, earned on the surplus funds, which are borrowed funds basically, and which are invested pending utilization for the purchase of the asset. These particular interest income is to be considered as income from other source and not to be deducted from the borrowing cost. Maybe you can just make a note of this. You can write it here. See, as per ICDS 9, income earned on the temporary investments made out of the borrowed funds which are pending to be utilized for the qualifying asset is not to be deducted from the borrowing cost incurred. Are we clear? Any doubt? Last one decision which is there in your module, which is on interest on the enhanced compensation. Interest on enhanced compensation for the land which is compulsorily acquired. So the assessee had received the interest, which in fact was not in the nature of interest, but was in the nature of the enhanced compensation. So see, it was not on the delayed payment of the compensation, but it was because the short compensation was awarded earlier. Now the compensation has been increased. Therefore, in that case, the interest amount is given because the short compensation was given earlier. Now, the question before the court was whether the interest amount which is given, which represents the enhanced value of the land and which takes the character of the compensation itself and not interest, whether it is capital gain or whether it is income from other source. So the court answered that this is in the nature of capital gain and not other sources because the interest is not for the delay in making the payment of compensation, but this is for the short payment of the compensation which is there. This is for the short payment of the compensation. If it is for the delayed compensation, it is income from other source. If it is for the compensation itself, for the short payment, it is in the nature of the capital gain. So maybe what you can do is, here you can make a note. Interest on enhanced compensation we have written here, right? Here, you can write it. Interest in the nature of compensation is capital gain. You can write the case Movelia Bikhubai Balabai. Bikhubai Balabai, Gujarat High Court. Clear? Are we clear? Any doubt? Okay. So this chapter is also completed. Now what I'll do is, since we have some time left, we will start with the clubbing provisions. Okay, we will start with the clubbing provisions. So let me just quickly get started with that. Now, this is a small chapter which you have also done earlier as well as part of your intermediate exams. Clubbing of income. But we'll quickly wind it up. Okay. So, clubbing of income, first section which is very, very important is section 60, where the transfer of income is made without the transfer of asset. Okay, here I will be making the usage of the Income Tax Act only, because this is very simple provision which is not very, very complex. So what we can do is I'll just put a note on this particular section 60. So transfer of income without transfer of the assets, section 60. Okay, so what does section 60 provides is, section 60, if you can see on your screen, it says that all income arising to any person by virtue of a transfer, whether revocable or irrevocable or not, and whether effected before or after the commencement of this act, where there is no transfer of assets from which the income arises, be chargeable to income tax as the income of the transferor and shall be included in his total income. So where the asset is not transferred but the income itself is transferred, then in that particular case, it will be considered as the income of the transferor. Okay, so I'll just write it in the short. Income of transferor. Because the assets are not transferred, but the income is particularly transferred. So if a person transfers the income without transferring the assets, such income will be included in the total income of the transferor. So let's say Mr. A confers the right to receive the rent. He signs an agreement with his friend that from tomorrow onwards, you will receive the rent. Or let's say there are two husband and wife, and the husband signs an agreement with the wife that from tomorrow onwards, the rent of the house will be received by you, but the house is owned by Mr. A. So without transferring the house, without selling the house to Mrs. A, he is just transferring the rental portion or right to receive rent by Mrs. A. In this case, the rent received will be clubbed with the income of Mr. A. Clear? Second is section 61. Income arising from the revocable transfer of assets. What is section 61? Income from revocable transfer. Income from revocable transfer of assets. So where the income is from the revocable transfer. Now what does mean by revocable transfer? If the transfer contains any provision by means of which the asset will be retransferred back to the transferor, or the transferor retains the right to reassume the power over the income of the assets, or it has the provision for transfer of the income or the assets back to the transferor, then in that case, it is considered as revocable transfer. Meaning, let's say, for example, if I have transferred the asset with the condition that after, let's say, 5 years, I will get back the asset. Or on the death of Mr. A, I will get back the asset. So this means it is a revocable transfer. Or on the birth of so-and-so person, I will get back the asset. So then in that case, the income will be included in the income of the transferor. So this will be considered as income of transferor. Clear? Now, the clubbing provision will operate even if the part of the income of the transferred asset had been applied for the benefit of the transferor. So even if, let's say, part of the income, not the entire rental income, is applied for the benefit of the transferor. if the house is transferred and even if the part of the rental income is used by the transferor, then the entire clubbing provision will operate to say that the transfer was revocable. So once the transferor transfers the asset, it should not have any power over the asset. Even if, let's say, part of the income is applied for the transferor's benefit, then the entire transfer will be considered as revocable and the entire income from the transferred asset is included in the income of the transferor. Clear? Now, what is not considered as a revocable transfer? If there is a transfer by way of trust, which is not revocable during the lifetime of a beneficiary. So if the transfer is not revocable during the lifetime of the beneficiary or during the lifetime of the transferee, then in that case, it is not considered as the revocable transfer and the income will not be considered as the income of the transferor. Provided the transferor should not derive any benefit from such income. If the transferor derives any benefit from the income will be included in his total income, even though it is not a revocable transfer. So you can maybe write it down over here. Income from revocable transfer of asset What is revocable transfer? Provision for retransfer of income or assets or right to reassume power over income or assets by transferor. Clear? By the transferor. What is not considered except in a case where transfer by trust not revocable during lifetime of the beneficiary or transfer not revocable during lifetime of transferee. Transferor should not derive any benefit from income, from the income. Okay. Transfer should not derive any benefit from income. Now, clubbing of the income arising to spouse, income by way of remuneration from a concern in which the individual has substantial interest, then the income which is arising to the spouse will be clubbed in the hands of the spouse, right? So let's say remuneration in cash or kind is received from a concern in which the individual has a substantial interest. Then in computing the total income of the individual, the income which is arising to the spouse by way of salary, commission or any other remuneration, whether in cash or in kind, that particular income will be considered as the income of the individual. Now, when an individual is deemed to have the substantial interest in a concern, where the concern is a company, and if the equity shares carrying 20% of the more 20% or more of the voting power are beneficially held by that particular person and by his relatives, and in any other case, if it is not a company, then if the person has a right to receive 20% or more of the profit of the such concern at any time. So section 64, remuneration of spouse from concern in which individual has substantial interest. What is substantial interest? In case of company, greater than equal to 20% of voting power. Others, greater than equal to 20% of right to receive profits. Right? And this along with relatives. Even in this case, it is along with the relatives. So 20% is to be calculated along with the relatives. Okay. What is relative? Relative means husband, wife, brother, sister, lineal ascendant or descendant. Relative means brother, wife, sister, husband, or let me just write it in short way, spouse or siblings. Spouse, siblings, children, and parents. These are the relatives. Clubbing provision will not apply where the remuneration is received in case where there is a technical qualification or professional qualification of the spouse. If the spouse is technically qualified or professionally qualified, then clubbing will not be attracted. So, not applicable if technical or professional qualification possessed by the spouse. Clear? Where both husband and wife have financial interest in a concern and both are in the receipt of the income by way of salary, such income will be included in the hands of the spouse whose total income excluding such income is higher. Whose total income excluding such income is higher. So let's say where both husband and wife are partners in the same firm, then in whose hand the clubbing provision will be attracted. So in that case, it will be in the hands of the spouse whose income excluding total income is higher. Clear? So if both spouse are partners, clubbing in hands of individual having higher income excluding this income. Clear? Any doubt? Okay. Then next is in the case of income by way of, second is income arising to the spouse from the asset transferred without adequate consideration. So where there is a transfer of the asset other than the house property from one individual to another who is spouse, otherwise than for any adequate consideration or in connection with an agreement to live apart, otherwise than for the adequate consideration, where the consideration is properly paid, then it's all right. Or if it is in relation to agreement to live apart, then also there will be no clubbing. Any income arising from the transferred asset, either directly or indirectly, shall be included in the total income of the transferor. So, income from transferred asset to spouse other than house property other than for adequate consideration or agreement to live apart, this will be considered as income of transferor. Clear? In connection with the house property, the provisions are under section 27, are provided under section 27. So if an individual transfers a house property to the spouse without adequate consideration or otherwise in connection with the agreement to live apart, the transferor will be deemed to be the owner of the house property and the annual value will be taxed in his hands, right? So house property, it is under section 27. So you can maybe write it down in this way. House property section 27. One second. Let me put it this way. If it is house property, this is section 27. Transferor, deemed owner, annual value to be taxed under section 27. Clear? Other asset, this will be section 64(1)(4). Income in hands of transferor. Clear? Any income from the accretion of the transferred asset. Let's say I have given the cash, or let's say I have given the fixed deposits to my wife or to my husband. Now the interest which is there on the fixed deposit, right, that will be clubbed. Now if I invest that interest also, that will not be clubbed with the income of the transferor. So income from the accretion of the transferred asset is not to be clubbed, right? That is not to be clubbed. The income arising on the transferred assets alone has to be clubbed. Let's say, for example, if I have given the house on rent, then the rental income will be clubbed. Now, if the rental income is deposited in a fixed deposit, that is not to be clubbed. Okay. So, income from accreted asset not to be clubbed. So clubbing is not attractive. Clear? Are we clear? Now, if let's say, for example, if the asset which is transferred is invested in a business, where the assets transferred are invested in the business, then the income arising to the transferee from the business is to be included in the income of the transferor. So the proportionate income will be added. Let's say, for example, if the capital is contributed, then the proportionate interest income will be added in the hands of the transferor. Are we clear? Any doubt? Any questions? Any doubt? Okay. Okay. Last one thing before we close this session. Transfer of assets for the benefit of the spouse. Let's say the income is not, so the asset is not transferred to the spouse, but the asset is transferred to any trust or to the association of persons by an individual without any adequate consideration for the benefit of spouse. Then the income which is there, which is used by the transferee for the benefit of the spouse, is also to be included in the hands of the transferor, which is under section 64(6)(7), 64(1)(7). Okay. So if it is transferred to any other person also, that will also be taxed in the hands of the transferor. So I will just put it here. 6417. To any person or association of persons from assets transferred directly or indirectly to the person to the extent the income is for the immediate or deferred benefit of, okay, this is for the son's wife, I have written over here. This is for the spouse. Clear? So that will also be included. So transfer to any person for benefit of spouse. Are we clear? Any doubt? Any questions? Any doubt? No, if it is for the performance of activity, if it's for the adequate consideration, then Jacob, it is not clubbing. Then clubbing will not be there. Okay. So let's close this session for today. In the next class, what we are going to do is we have to do set off carry forward. Some part of the clubbing is left, which we'll complete in like 10-15 minutes in the start itself. Then we will do the set off carry forward and then we'll start with the deductions. Clear? Okay. So thank you so much. See you in the next class. Please revise whatever we have done today.